If you haven't completed already, please make sure you've read and completed the week 1 academic integrity module. There's just a handful of students that have not yet completed that. So if you are one of them, please take the time to do so at your earliest convenience. The second thing I want to remind folks on is, or mention, is under the evaluations quizzes, chapter 13 that was due on 22nd. I have extended it till tonight because I know there were at least a handful of students that reached out to say, hey, I lost my hydro for 2 days and didn't get it back to Sunday afternoon or, or even Monday morning. I know I'm one of those. Went out Saturday before lunch and didn't come back on until Monday afternoon. So I did extend that till tonight. So if you have not written it, please take the time today if possible. Okay, so it's the chapter 13 quiz. And then we'll leave the chapter 14 quiz as is for May 29th, and hopefully no more natural disasters come up, etc. So any questions on the chapter 13 quiz so far? Just a purposeful pause. Otherwise, we'll jump into chapter 14 here and we'll walk through some questions and some examples. Chapter 14, just a couple of slides I actually want to review. I'm not going to go through the whole slide deck because a lot of it you'll get through the application of exercises. And what you really want to focus on is slide, I guess, 4 and 5 is where I would, we'll review today together. So 4 and 5 talk about, when you're looking at more sophisticated financial instruments, there's always, it's either a financial liability, which means you have a contract in place to pay or deliver an asset to another party at a set period of time. So it's a financial liability. So you record the liability today and you're going to settle it at some point in the future. Or there could be an equity instrument. So if there's a contract in place, that means that they could trade or gain access to a portion of your business at a period of time. It could create what's called an equity instrument, okay? And we'll walk through some examples on how that comes into play. I find that's typically the easiest way to look at this chapter. The other component, and this will come into play too, and some of the examples in this chapter, are there are 2 different ways to value these financial instruments. One is the residual value method, which in most of our examples are following the residual value method because it is what's accepted by IFRS and can be used for ASPE. So residual value looks at the conversion rates are valued at the difference between the bond purchase and the value of the bonds if they were not convertible. Okay, well, again, we'll go through some of those examples. The zero equity method is only allowed if you're following ASPE. And it assigns the full value of the net debt, and we don't look at the equity. Okay, so we'll deal with that later, is basically what ASPE says. So in most of our cases today, we will focus on the residual value method. You'll see some calculations around that accordingly. So what I'd like to do is just get right into some questions on it. And if you don't know yet, that's okay. We'll work through it together. I'll answer any questions you might have on other exercises, etc. So what I'd like to start with is just like last week's, the last couple of weeks, we've had a Google Doc. So under the chapter 14 for complex financial instruments, we have a Google Doc for chapter 14. I've got it open on another tab already. So if you do want to follow along, feel free. Chapter 14, Google Doc for chapter 14. And hello, Hussein in Iran. All right, I'll just give you a minute to pop in. Zoom in a little bit here. So for those that want to pop in, again, chapter 14, Google Doc. All right, I see a couple of you popping in, great. All right, so while we're waiting for any other folks to jump in that want to, gain access to this file, we'll just get started. So you hopefully have covered some of this in some of your pre-reading on the chapter from the text. And if you're not sure, that's okay. We'll work through it together. So the first question is just a simple yes or no. Is an entry required when a stock option is granted? So I don't know if anybody wants to, say yes or no in this case, and possibly Why? So just thinking about when it's granted. So say, you know, today it's May 25th. I tell my boss or, you know, or my employee, you know, I'm going to give you the right to, you know, redeem stock options in the future for the next 2 years at X dollars. Do I have to record a journal entry today? And just waiting to see if anybody wants to type, but no. The answer is no, not when it's granted, only as time passes, okay? And again, we'll do a couple of examples of these. So when it's granted, say January 1st, but it's good for 2 years, so at December 31st of the next 2 years, you would record a portion 1/2 each year. So yes, the answer is no in this case. So then let's move on to question 2 then. Sorry. So question 2 talks about a bond with a conversion option. We sold it for 1.2 million, okay? And the conversion option allows the bondholder to convert their bond to common shares. The present value of the bond without a conversion option is 1,134,600. So what is the journal entry? Ying, I just covered a couple slides from the PowerPoint, but yes, we're right into the exercises now just to do some application. So I was answering a question in the chat. So on this one, number 2, everybody want to take a stab at what the journal entry might be. And if you haven't had a chance to review the text, that's okay. We'll cover some examples together today. So anybody that has covered it, do you want to take a stab at what this journal entry might be? If you're unsure, you can pop open some of your ideas over on this right-hand side, perhaps, and then we can pull in the right options. So the first thing is, what did we sell the bonds for? Looks like, so if we sold the bonds, we're actually getting, would I venture to say we're getting cash? Okay. So in this case, we're actually getting cash for the sale of the bonds. Ah, look at that. Somebody jumped to question 3. So we're selling cash. How much cash are we getting? Anybody want to populate that right here in cell I9? Anybody want to populate? How much cash are we getting? 1.2 million, correct. So that's how much we're sold for. Now, the second part says the present value of the bond without the conversion option. What account does that one go to? So the present value of the bond without the conversion option is 1134. So we're told the present value. So you might recall that from last week, the present value of any future stream of payments and the future outlay of the repayment of the bond value goes to bonds payable. Okay. So there's no calculation needed in this case. So we're told the bonds payable amount is, and anybody want to populate that one? Not quite 1.2. So this is assuming IFRS. So it's always at the carrying or present value. And we're told the present value is perfect, 1,134,600. So I'll just make a couple of notes here. I'll just paste them in here. So the cash is the amount we received, and the present value of the bonds without the option feature is the liabilities. That's following the residual method. So the difference then is, and somebody typed it, thank you, is contributed surplus. And typically you could very often have more than one type of contributed surplus. I would actually amend this and call it bond conversion option, because you might have contributed surplus for other bonds, for other debt instruments. Okay, so be a little more specific. That's good. And how do we get that value? Okay, that is correct value. And again, how do you get that? Is a difference is the contributed surplus portion. Okay, so that's the value of the shares that we assign based on the contributed surplus. So far, so good. Any parts you'd like repeated from question 2? Oh, I just saw in the chat bond payable. Yes, that's correct. So anything you'd like repeated for question 2? Oh, so why? It's because typically when you have a bond with a conversion option, a buyer of that bond would pay you a premium, because not only are they guaranteed to get the $1.2 million back over time and interest payments over time, but they also have the option of converting that bond to stocks. So that premium they pay is called a contributed surplus. Okay. So they're paying an extra $65,000 to have the right to possibly convert to common shares at a future date. Again, just answering a question in the chat. And I like it. People are jumping in. Perfect. Okay. So on number 3, somebody already answered this, but what type of account is contributed surplus? Yes, it is equity. So if you recall your equity section, then you would vary out under your shareholders' equity section. You'll typically have, you might have common shares, you might have preferred shares, you might have retained earnings. Then we just spelled that wrong, but then you'll have your contributed surplus items. So you might have more than one contributed surplus. Okay, so all of these are part of your shareholders' equity in this organization. Is there a tab button up here? You tell I don't like Google Sheets, but anyhow. So it is equity. Any questions on what, otherwise why it's an equity? It's because it has the right to be converted typically to another item within that equity section. All right, moving on to question 4. And somebody jumped on it again. I like it. At what value should derivatives be reported? And yes, they should be reported at fair value. So based on what they could be worth today. And that's just like most assets. So I'm just going to make a little comment here. So like most assets or liabilities, we always report at the fair value. Again, I'm pausing for questions as we go. All right, number 5, somebody jumped. Again, keep it going. So the carrying value of a bond with a conversion feature, okay, is 1,567,890. The conversion feature allows converting bonds to common shares. The value of contributed surplus related to this issue of the bond series is 167.9. And if all bondholders decide to convert their bonds to common shares, what is the journal entry? So yes, so in this situation, our bonds payable then, our current carrying value, so that's what's sitting as a liability. So let's go, this is sitting as a liability as of this date. So we need to clear the liability because they are converting their bonds. So it'll be a debit to the liability to get rid of the bond payable. This contributed surplus would be the amount that's sitting as equity in our shareholder equity section as of that date. And we need to remove it because we're replacing it with common shares. So they're exercising their right to convert their bonds to common shares. So we need to clear out the bonds payable. We no longer owe it. We clear out the contributed surplus because they've all been exercised. So the total value then becomes the value of the common shares because we are no longer paying those items out. We are keeping them, but they're shifting from a liability and an equity to common shares under the equity section. So the total of this transaction then is the $1,735,790. Okay, so this is just talking about as a point in time, here's your carrying value, here's your contributed surplus, they're converting. So we need to remove those components and set up common shares. Just pausing. Questions so far? Okay, let's move on to question number 6. And again, somebody's answer. Awesome. Hopefully this makes sense. On January 1st, Paul Corp purchases a call option and we paid $500. So yes, it'll be a credit to cash because we gave up cash. The call option gives Paul the option to buy 1,000 shares at a strike price of 30 anytime during the next 6 months. What's the journal entry on January 1st? We're not looking at the call. We're just looking at what we paid out today. So there's now an options derivatives or just derivatives, whichever you call it, as a debit derivatives and a credit to cash. So we hold this asset as an option to buy future shares. But we're not exercising the option at this moment. Okay, so that part's hopefully straightforward. If not, please ask. And then we'll move on to question number 7, related to 6. All right, moving on to number 7 then, is on March 31st, so 3 months after the original call option purchase. The market price for the stock was now $42 per share. And the fair value of the option was now $17,500. Okay, so the option that we hold, we're not exercising it yet. We're just marking to market for the fair value of our option. So if our option is now worth $17,500, we have to subtract the $500 originally on our balance sheet or statement of financial position. So we need to adjust the fair value of the options by $17,000. It's an asset. Sorry, I'm being asked a question in the chat. Options derivative is an asset. It's something that you own that has a potential future value. So we have $17,000 as an option derivative plus the $500. Our fair value of that asset is now $17,500. And the gain on derivatives is now $17,000. So that's typically another comprehensive income, unless you're in it for investing. But most companies just do this on the side. But either way, it's an income. Okay, questions on this so far? Oh, BS balance sheet. Sorry, some people call it balance sheet or the statement of financial position. Those are two. Oh, I spelled that wrong. Those are the 2 most common names for statement of assets and liabilities, equity. All right, let's move on to number 8 then. Number 8 says that Sunland Corp granted 6,200 options to executives. Assume that the option's fair value is calculated using options pricing model is $132,000. Each option entitles the holder to purchase 1 share of the common shares at $28 per share anytime. That's ridiculous, 1 share. After January 1st, year 3. So what is the entry on January 1st, year 1? We answered this at the very beginning and somebody picked up on that. Great. So the very first question, is an entry required when the stock option is granted? And the answer is no. Okay, so there is no entry on the grant date. But now we need to roll forward. Say, okay, question 9 says, what's the entry at the end of that first year? So I don't know if anybody wants to take a stab at question 9. So a year has passed. The options pricing model valued the fair value at $132,000. So does anybody want to take a stab at what their entry is at the end of the first year? Oh, looks like somebody's in there. So I'll give you a moment. Oh, maybe changed your mind. All right, so in this case, we need to record a compensation expense. So the year has passed, 1 year out of the 2 years timeline for their options. Okay, has passed, so we need to record the compensation expense for 132,000 divided by 2. So we'll record that expense over the period until that option is expired. So in this case, we have a contributed surplus again. That's why it's important to have a little extra name. In this case, we'll call them contributed surplus for stock options. So this sits in our equity section again until it's converted to shares. Okay, or if it's never converted to shares, it remains in there as contributed surplus expired options. Okay, but it'll always stay in the equity section. And then December 31st of year 2 would be the exact same entry. Okay, so you'll see the 66 year 1 plus the 66 year 2, there'll be $132,000 sitting as a contributed surplus for stock options as of the end of the second year. So then somebody's already starting it, great. Related to question 8, number 10 says, if they're all exercised, what's the journal entry? I'll just pause for a moment. And maybe I'll just point a hint. So if you look at the balance of contributed surplus stock options, we had 66,000 in year 1, 66,000 in year 2, and these are credit balances. Where's my sum? Sum of those. So this is sitting as a credit balance at end of year 2. Okay. Just waiting for you to think here. All right, getting close. Close. Almost. Anybody else want to take a stab? If somebody else, maybe you want to, somebody else populates different boxes here, debits and credits. Let's give you a minute to think about this. I'll give you a hint. This contributed surplus stock options as a debit for 132 is correct. We need to get rid of the contributed surplus because all of the options were exercised. So that is correct. So this line item here is correct. Let's make it green for correct. Okay. You will have a credit to common shares. I won't tell you what it's for yet. Okay, I'm answering a question in the chat. Exercise means the executives that were given these stock options decided to take advantage of them. They exercise the options, so it means they are going to execute the options, which allows them to buy a share of $28 per share. And there's 6,200 options. So in this case, this top line then actually is cash. So the executives, in order to exercise the options, need to pay the company cash. And how they pay for that is the 6,200 shares times the $28. And somebody just populated that in, 6,200. You can see it here. So I'll just put 6,200 times $28 is the 173.6. So they're actually giving the company $173,000 in cash. Then the company needs to remove the contributed surplus for stock options that they've added up over the last 2 years. So we will debit the contributed surplus. And now the total of those two pieces becomes the value of the common shares that was just executed by those executives. So it has nothing to do with the market cost in this case. I know we didn't tell you up here, but that's how it comes out. So the cash is the amount that the executives have to pay to execute. Contributed surplus removes all the contributed surplus accounted for from the time it was granted till the time it was executed. And then the common shares are the sum of those two items. Let me put these. Okay. Questions on this one? Takes a bit, I'm sure, to get your head wrapped around some of this. That's okay. All right. Any other questions on this Google Doc? Otherwise, we'll jump into the exercises and do a few together. Example 3 in this document, or the other one you mean? Okay. I was actually 3 is one of the ones on my list. I was going to do 1, 3, 5, 8, 9, 10. This is the 5 or 6 I was going to pick out. All right, so let's move over to the exercises then. So if you haven't downloaded them, download the chapter 14 examples. And I've got them here. All right, so if you want to download this Excel file, then you can take your own notes and do whatever you desire. Or if you want, or if you learn better just by watching, feel free to watch as well. And since Emily asked, I'll jump to example 3 first. And then I'll go to some of the other examples. I've highlighted in green the ones that I was going to take you through. And if there are others, just let me know. So let's jump over to example 3. So I'm just pulling up my notes so I have it too. All right, so example 3, we have this company, Port Corporation. They follow IFRS. Okay, so you know we need to present value things. We issued a series of 400 convertible bonds maturing in 5 years. The face amount of each bond was $1,000. Bridgeport received $436,000 for the bond issue. The bonds paid interest on every December 31st, 6%. Market rate was 5. The bonds were convertible to common shares at a rate of 10 common shares per bond. Bridgeport amortized bond premiums and discounts using the effective interest rate method. So if you recall, that's what we covered in chapter 13. And the company's year end is December 31st. And then we're told some other pieces too, but let's just focus on this first section and then we'll jump to the next pieces. So the first thing then is we need to record the issuance. So here we are on day 1. So we've got January 1st of year 2, we're told. We're told we receive cash, and you can feel free to type notes in the chat or go on mute. But we have to record how much cash we received, and we're actually told the amount. Bridgeport received $436,000 in cash. So in this case, we need to record the debit to cash accordingly. The next part says we need to calculate 2 things. So we always need to set up the liability based on the present value of the bonds payable because they're following IFRS. And then the difference is your contributed surplus for the fact that these are convertible bonds. So what I'll do, let's bring this in. Okay, so we need to do some calculations before we can determine the amounts. If you remember the present value formula from last week, we need to know the rate, we need to know the number of periods, we need to know the payment, we need to know the future value and the type. In this case, the rate for your discounting for the present value is always based on the market rate. So we'll use 5%. So the market interest rate for the bonds comparably is 5%. How many periods? We're told it's 5 years, but if you recall, we're going to need to make sure how often is the interest paid. And right here, it says the bonds paid interest every December 31st, so once a year. So 5 periods is correct. If this said it pays twice a year, our periods would be 10, 5 times twice a year, but then our rate would be divided in half because it pays every 6 months. It's not the case here. The payment is based on the stated interest rate. So the stated interest rate is 6% on the $400,000, okay, of bonds. So it's 400 bonds at 1,000 each. So 400 bonds at 1,000 each, 6% paid per year. So we have negative 6% times 400,000. So we'll pay out $24,000 per year in interest expense. So make sure that's a negative payment. And then the future value are the par value of the bonds. So that's our negative 400,000, or our negative 400 times 1,000. So it's our negative $400,000 payment at the end of the year, or end of the 5 years. And then type, it says right here, it's issued at the end of every year, so our type is 0. Remember, if it's paid at the beginning, it's type 1. Typically only applies on leases, which you will cover later. So it's type 0. And then we can calculate our present value. So we have our rate, our periods, our payments, our future value, and our type. So our present value of the bonds payable is $417,317.91. So I'm just going to round that to no decimals, just to make it easier. Okay. So we have 417,318 will be our original carrying value or present value of our bonds payable. I'll pause here. Any questions on this so far? All right, and then because we received 436 in cash, our liability is only 417 based on the present value of future payments. Our difference is our contributed surplus. We can just take one minus the other. So I have 18,682 as our credit to contributed surplus. So that's our initial entry. Just pausing to see if there's any questions so far. And hello, Brittany. All right, so the next thing says, don't forget, I think it said somewhere, something about creating an amortization schedule. Oh yeah, right here, don't forget to create an amortization schedule. So let's set that up. Amortization, oh, come on. And we always have the columns, as we talked about last week, date, the cash amount, the interest portion, the amortization portion, and the carrying value, the CV, the carrying value. And the original carrying value is the $417,318 as we just calculated, and that's as of the very beginning. So then our amortization schedule then, we'll roll this forward for the 5 years. And we're told that the payment is actually $24,000 every year. It's the 6% on the 400,000. So we can record the fact that we're going to pay $24,000 in cash each year. Our interest, if you recall, is always the comparable level of risk interest. So this will be equals around the 5% times the carrying value. I'm going to round to the closest dollar. And the amortization is simply the difference in the two. And then our carrying value is slowly declining in this case because you want to get it down to 400,000 by the end of the 4 years. And we've got a $1 rounding here. That's okay. Maybe I can just, I'll just leave it. There we go. I overwrote it. Yeah, that was the formula still there. Okay. Any questions on the amortization schedule, just like we've done in prior week? Yes, so so how do we calculate interest? Or I'm just reading the chat. How do we calculate interest? Interest is equal to the market rate of 5% times the carrying value. Okay, so if you look at my formula here, it's the 5% times the carrying value the moment before. And that's why it's slowly going down each year, because our carrying value is slowly declining closer to the 400,000. Does that help? Okay. All right, so it says, what do we want to do? Prepare all required journal entries. Okay, so now we roll forward to December 31st of year 2. So we need to create a journal entry to record the interest that's being paid. So I'm just gonna paste it over here somewhere. Oops, that's not gonna work. There we go. So to record our interest expense at the end of December 31st, year 2, it comes from our amortization schedule. We paid out cash, so it's a credit to our cash for $24,000. That's the 6% on the $400,000 bond. The interest expense is calculated as per the effective interest rate method, which is why this table is handy. And then our bonds payable are reducing by $3,134. So our carrying value at the end of December 31st, year 2 will be $414,184. All right. Sorry, I thought I put on silent. I apologize. All right, so let's move forward then. And it says on January 1st of year 3, so that's the next day after this entry, 80 of the bonds were converted into common shares. And if you look, 80 out of the 400. So there were 400 initially. We are converting 80 of them into common shares. And then we're told 6 months later on June 30th, another 80 were converted, and the bondholders chose to forfeit the accrued interest on these bonds. So in this case, we need to look at a few things. First of all, we need to look at our bonds payable. What's our current carrying value? And that represents all 400. And if 80 out of 400 or 20% are being redeemed, then we can take out 20% of our bonds payable. So I'm going to paste this in and we'll walk through the calculations. I'll have to fix this in a moment. Sorry, just bringing in my notes. All right, so then in order to calculate this, oh, that didn't work. Okay, I'll fix that in a moment. All right, so our bonds payable, let's start with that amount first. 20% of the carrying value, so we pick up the 414. Okay, 184 is our current carrying value as of the day before they redeemed. 20% of that value is 82,837. So we're reducing our bonds liability by 20%. 82,837. The contributed surplus of the convertible bond options started at 18,682 as per original entry, and 20%. I'm just going to round that. 20% times the contributed surplus needs to be removed as well. So it's a current liability in our equity section. Sorry, it's a current equity on our balance sheet. So we need to reduce that equity of the contributed surplus because people are actually converting their bonds. So our contributed surplus is 3736 as a debit. It's reducing. And therefore the common shares that they are converting to are worth the sum of the two components. So being 86,573. So now we have a credit to common shares for the value of the converted bonds. 20% of the bonds payable plus 20% of the contributed surplus. A pause there so far. Questions so far? 20%. 20% is calculated based on, right here, I've got a note, 80 of the 400 bonds is 20%. So therefore we take 20% of those values. Just answering that. Okay, perfect. All right, so let's move forward then to June 30th of year 3. And another 80 bonds were converted into common shares. So let's move forward. So in this case, let me see. I'll bring this in and then I'll walk you through it. And this is not working. I don't know why my formulas aren't copying, but that's okay. I'll fix it. And this is as of 6:30, not 6:1. All right. So in this case, our first component is our interest expense. So how do we calculate our interest expense as of June 30th? Because another 6 months have passed by. So our interest expense then, we look at the carrying value of 414,184, which is what it was. Some bondholders already redeemed 6 months ago. So our 414 less the 82,837. Okay. So our actual carrying value would be 414,184 is 331,347 as of the day prior to this transaction. Then we take our 5% interest payment, and it's for 6 out of 12 months. Oops, that didn't work. 6 out of 12 months. And then this, we only want to record the entry for 80 out of 320 remaining bonds. So remember, there was 400. We redeemed 80. So 320 left, 80 more are being redeemed. So in this case, to calculate that the interest expense portion, we need to debit our interest expense by this calculation. The carrying value times the 5% over 12 months divided by 12 times 6. It's 1/2 year. But only record the 80 out of the 320 bonds in this case. So our interest expense is $2,071. Our contributed surplus is actually the same amount as our prior entry because it's another 80 bonds. It was 80 bonds the first time, it's 80 again. So it's as simple as taking the same rate or same amount of our contributed surplus of 3,736. Our bonds payable, it's again 20% of the carrying value. The carrying value, the original carrying value is 414,184, so it's the same amount as our previous entry. This is the day before we're recording the rest of the interest. I think that's what's important here. Just double checking. Yes, June 30th. And then the sum of that becomes our common shares. So our common share value in this point is 88,644. And it makes sense because more time has passed. So therefore, the value of those bonds has gone up, right? Because they foregoed their interest earned. I'll pause there. Oh, hello, Brittany. I can't remember if I said hello to you or not. So the next thing that might help then is we want to revise the amortization schedule. So now that we've done a whole bunch of these redemptions, we need to update our amortization schedule. So I'm going to bring this in. And that did not work. What the heck, man? We'll fix this. I'm off rows for some reason. I'll fix the rest as we go. So, all right, so our original value is 417,318. We paid the $24,000 in cash. And why we dropped this, okay, is because we do have 2 redemptions of 82,837 before we make the next payment on December 31st, year 2. So that's why this amortization schedule, because we only pay out once a year, we need to modify it based on any transactions to the carrying value before the 2 dates of interest payment. So for interest payment was December 31st, year 2, and December 31st, year 3, and we had 2 redemptions, one on January 1st, one on June 30th, we need to reduce our carrying value by both of those entries. So let me fix these. I think that was, I think that fixes it. Good. So this 12/31 year 2, the cash is still 24,000 out, still interest of 2866, still amortization of 3134, but the carrying value looks at the opening, less the amortization, less the two conversions. Oh, hold on. Alexa's talking to me now. All right, so then moving forward to year 3, then our cash paid out is the stated interest rate still at 6% of the remaining bonds. So if we've given up 80,000 and 80,000, our remaining bonds are only $240,000 in face value. So our interest payments starting December 31st of year 3 would only be $14,400. Using the effective interest rate again, the 5% times the opening carrying value would be 12,426, and then our amortization drops accordingly. And you'll see that our carrying value eventually gets to 240,000, assuming no further redemptions. I'm just going to finish off this and see if there are any questions. So therefore, on December 31st of year 3, we need to record the interest expense. Revised interest expense would be 12,426 as a debit. Our amortization, bonds payable, 9,974. And the cash that we pay out would be 14,400 as calculated here, 6% of the $240,000 in bonds. Before we go to the last entry, questions so far? Anything you'd like repeated? All right, so let's move on then. The last thing then says on January 1st of year 4, so the next day, when the fair value of the bonds was 249.9 due to a decrease in market interest rates, a conversion inducement of $21 per bond was offered to the remaining bondholders to convert. All of the remaining 240 bonds were converted into common shares. So there's a bunch of calculations here we need to go through. And again, these aren't working. I just need to fix that. Okay, we'll come back to these. All right, don't look at some of these numbers for a moment. There we go. So first thing we need to do is clear all of our bonds payable. So in this case, our carrying value as of January 1st of year 4 would be our carrying value as per the amortization schedule here, 246,536. So that's what'll be on our balance sheet. So we need to debit the bonds payable for that amount. The contributed surplus would be what we started at, less the 2 redemptions made. Okay, and it's 11,210 according to this, and you might round to 209. So if just to follow that along, contributed surplus started at 18,682. It was reduced by 3,736 for redemption number 1, another 3,736 for redemption number 2. So for our contributed surplus remaining is 11,210. So we need to debit to clear that out because all the bonds are disappearing. We can now do the common share value. So the common share value is based on the bonds payable plus the contributed surplus, 257,746. Now for the other component of what the company offered as an inducement to convert, we had 240 bonds, and we're told that the company offered them $21 per bond to convert now. So the company is giving cash to those bondholders. And how we calculate that cash, it's the inducement amount of $21 times the 240 bonds. So we have a $5,040 cash outlay, credit to cash. The opposing debit to that component will have two components. One, it will be a loss or gain on conversion of bonds. And then whatever the difference is will be in a permanent adjustment to retained earnings. How do we calculate that gain or loss on conversion of bonds? We have to look at the fair value of the bonds and the carrying value of the bonds. So in this case, we're told the carrying, or we know the carrying value is 246,536. And we're told the fair value of the bonds is 249,9. We actually have a loss on conversion of bonds, okay, because the fair value is greater than the carrying value. So our 3364 is a debit to an expense account, loss on conversion of bonds. And the difference is a simple adjustment to retained earnings to enact this transaction. And that's this question in a nutshell. I know it's a lot of moving parts. Emily or others, questions or parts that you'd like repeated? You're not seeing any questions come in so far? Are you thinking, or you just need time to digest some more? All right, let's jump over to example 5 then. So example 5, we'll talk about some stock-based compensation plans. So stock-based compensation plans, we have this company, it's for the senior execs. They have a December 31st year end. And on January 1st, we introduced the plan. So on January 1st, the company issued 270,000 options to management for the purchase of shares at $10 each. The fair value of the options is 1,890,000, almost 1.9 million. And options vest over a 3-year period, and is estimated that 90% of the options will vest. At the end of year 4, any unexercised options will expire, which means they can't exercise those options after that point in time. So on December 31st, year 1, we now estimate that 85% of the options will vest. So the first thing to think about, what are all the different journal entries? And we said when you first of all issue stock options, there's no entry. So the date of issue, there's no entry. It's only as time passes that you recognize those compensation expenses based on your year ends. So at the first year end, December 31st of year 1, we'll look at the fair value of the options. The fair value is 1.89 million. It's to be vested over a 3-year period. So we'll take the 1,890 divided by 3 years. And then we're saying, we're guessing 85% will vest. And how do they come up with that? Maybe they've issued it before, and that's typical, a reasonable assumption. And so they state their assumption. So in this case, they need to record compensation expense debit and a contributed surplus for the stock-based option plan for 535,500. So it's the 1,890 divided by 3 years times 85%. Moving on to year 2, we're then told they think 80% of the options will vest. So we look at the fair value, assuming the fair value has not changed, 1,890. We're now 2/3 of the way through. So we'll take 2/3 of the almost 9 million, but now times 80%. I think only 80% are likely to exercise their option. So in this case, we take that calculation, less what we've already recognized as compensation expense as of the previous year. Our current year compensation expense in year 2 then is only $472,500. So the total of these represent 2/3 at 80% of 1.89 million. Moving forward, another year, December 31st, year 3. Okay, we're not told to make any further reductions in the percentage that are likely to vest, so we will assume the 80% still holds. So 1.89 million times the 80%, we're at year 3, so it's 3/3, 100% of it, times the 80% likely to vest, minus what we've recognized before, so we have the 1,008,000, gives us $504,000 to book for year 3's compensation expense. So now the next part says January 1st of year 4, 90,000 of the 270,000 options are exercised when the market price is $15 per share. So in this case, need to do a couple of things. First of all, they exercise 90,000 out of the 270,000, so it's 1/3 of the options. So we need to take 1/3 of the contributed surplus away because it's no longer contributed surplus, it's now recognized value of common shares. So we look at the total value of contributed surplus being the 535, the 472, and the 504,000 you can see on screen here. So the value of that is 1,512,000. We take 1/3 of that for the percentage, so we reduce our contributed surplus debit for 504,000. Those senior execs have to pay a fee for those common shares, and what they pay is based on the plan. And up here, we're told the plan is they can purchase them at $10 per share. So the executives will pay the company $10 times the 90,000 options, otherwise known as a debit to cash for 900,000. We're getting cash from our employees. And then the common share value assigned to those 90,000 shares will be $1,404,000. So it's a credit to common shares. Just wait in a second to see if any questions on that. And then let's assume that we roll forward to the end and no other shares options were executed or exercised. So the rest of the contributed surplus for the common share option plan needs to be removed. So our contributed surplus for CSOP would be the original 1,512,000 less the 504,000. So we have 1,008,000 left. So it gets debited to the contributed surplus CSOP, but it becomes a contributed surplus for expired CSOP, okay? Because it's no longer exercisable or an option that the executives can exercise because they've left that value in the business. Okay. Questions on example 5? I'll pause here for a moment. Are you still there with me? Yes, all right, thank you. All right, let's jump over to question 8, unless somebody has a question on that other one. This one's a little less complicated, just to try some other concepts from this chapter. All right, let's look at example number 8 then. We have, oh, I just realized there's a spelling mistake in here. Cucumber Limited issued 875-year 9% convertible bonds, $1,000 par each, with interest payable each December 31st. Each bond is convertible into 100 common shares. Current value of each common share is $5. Similar straight bonds carry an interest rate of 11%. So first of all, under IFRS, we need to figure out the present value of those bonds. So if you remember what we need all these different calculations: present value, rate, the number of periods, etc. And our rate is based on the market rate, so we have 11% in this case. Similar straight bonds carry 11%. How many periods? We're told 5 years, and it's payable once per year, so 5 years is correct. Our payment value, and let's throw a little calculation over here. So how many bonds do we have? We have 870. The dollar value of each bond is $1,000. Therefore, the face value of the bonds is $870,000. We're told that we're paying 9% per year. So therefore, we're paying $78,000. So this is the interest rate. We're paying $78,300 per year in interest. So that's the actual interest we're paying, not the effective interest. So, oops, negative 78.3. The fair value or face value of the bonds, we've calculated over here at 870,000. Sorry, face value. And the type 0 because it's paid at the end. And then we can do our present value again. So our rate, periods, payments, future value, and type. So in this case, we have 805,691. Okay, any questions on present value? Hopefully you're doing a bunch of these, so it's become a lot easier. And again, if you haven't started using Excel for present value, you should, because it's a lot easier than typing on a calculator, in my opinion. Some were asked to record it under IFRS and ASPE. So IFRS, we needed this present value. So I'm going to just pop it over and then we'll walk through it. So under IFRS, first of all, how much cash are we getting? We received the $870,000 from our bondholders. 870 bonds, $1,000 each. Our bonds payable liability is based on our present value calculation of 805,691. So that's our credit to liability. And because it's a convertible bond, the difference becomes a contributed surplus for convertible bond options. Okay. Under ASPE, there's no present value needed. We just simply put the value of the cash to the value of the bonds payable. And we don't separate the conversion feature. Okay, so ASPE is very straightforward, but it's also not commonly used for orgs that can use ASPE, just saying so. Questions on example 8 or anything you'd like to cover again? All right, let's jump over to question 9. We'll just do a couple more together. Then if you have other questions, we can stay and hang around and do some, but yeah, we'll go from there. So question number 9, it says that this company issued 550 convertible $1,000 bonds at 103. And after issuance, similar bonds were sold at 97. Okay. assume that Lansing Capital follows IFRS and recorded the issuance of the bonds and conversion rates accordingly. So we're just assuming they've done the original records. On a date when the bonds had a carrying value of $538, Lansing paid $13,200 to the bondholders to induce an early conversion. So we need to record the conversion using the book value method. So in this case, our bonds payable, and let's just go. So we're told that our book value was $538. So this is based on book value. So we need to remove the bonds payable, and we're told what the book value is. All right, so then we need to calculate what's the contributed surplus. Contributed surplus convertible bonds. And how do we calculate that? What should it be? So the bonds were issued at 103. So it's 550 bonds times $1,000 each times 1.03. They were issued at 103. Similar bonds would have been issued at 550 times 1,000, but at 97, so 0.97. So therefore, the contributed surplus on these bonds would be the difference. So our contributed surplus would be $33,000, the difference of the issued rate versus comparable or similar bond rate. So we need to debit our contributed surplus to remove it for the $33,000. Now we know there's likely going to be a loss on conversion. Okay, then we have the common shares. We'll come back to the loss in a minute. And we have cash. Our common shares will always be the value of their bonds payable that are being converted plus the contributed surplus. So our common share value is $571,000. Our cash being paid out, we're told right here, $13,200 is the amount that's paid out. And therefore, the loss on conversion of bonds is the difference of this transaction, which happens to be the $13,200. Okay, just to make sure we're in balance, 584,200, 584,200. And just notes here. Okay, so all the bonds have been converted, value of the common shares, etc. Questions or points of clarity on number 9? Any other examples you'd like to do today? Otherwise, maybe I'll let you go and do some work on your own. You can reach out to me as you need to. But this chapter is just more and more and more of that. Sorry, Brittany, how did you get the similar number? Which number? Sorry, Brittany. The 533. Oh, okay. Yeah, I'll spell it out. Not a problem. So the 533 is the 550 bonds. So let's do the number of bonds, face value each, and then the rate. So in this case, it's 550, 1,000 at 1.03. This is 550 at 0.97. So we go this times this times this. So it's always the number of bonds times the value, face value of the bonds, which are 1,000 each, times the rate. Let's just move that down a little bit. Okay, no problem, Brittany. Other questions on this? And again, this chapter, you'll just do lots and more and more and more of these. But these are the primary examples that you'll use. If you're working on an exercise later on your own and it doesn't quite make sense, please reach out. Either we can make time to connect, or I can send you a little, 5 or 10 minute recording on something if that's helpful. I want to try to respect everybody's time and balance. Any last questions for today? Got a thumbs up. Thumbs up, Brittany, means you're okay for now, or thumbs up, you have more questions, you're typing it. Ying, Melik, Elizabeth, Gladys, you're okay, Brittany, thank you. Emily, thank you for showing up. No problem. Again, practice, practice, practice. Reach out and take care. Take care, Gladys.